Today, a street food vendor in rural India can process a digital payment faster and honestly cheaper than a Wall Street hedge fund can clear a cross-border trade. Let that sink in for a second.
It really is wild when you frame it like that. I mean, it's one of the most fascinating socioeconomic shifts we've seen.
Right. How did a developing nation leapfrog the legacy financial systems of the West? They didn't do it by building more bank branches.
Yeah.
They did it by building digital plumbing.
Exactly. We are talking about a complete reimagining of what a central bank actually does on a day-to-day basis.
And that is exactly why we are here today. Welcome to the Deep Dive. We're exploring a highly detailed document on the functions and working of the Reserve Bank of India, specifically zoning in on Chapter 24, which covers fintech and the Reserve Bank of India.
It's a dense chapter, but it is incredibly important.
It is. But let me be super clear about our mission today. We are acting as your expert academic researchers and instructional designers. We're not just going to read you a table of contents.
Right, no one wants to just hear a textbook read aloud.
Exactly. So if you are prepping for a high-stakes board meeting, a major regulatory exam, or if you're just trying to understand the actual mechanics of global digital public infrastructure, you need a mental model.
You need to understand the architecture, like not just what the systems are, but how they interact, why they were built, and the specific friction they were designed to eliminate.
Yes. So we are going to construct a highly exhaustive blueprint for an infographic. Think of this as a mental study guide so comprehensive that once you finish this deep dive, you will have achieved total mastery of the chapter without ever needing to read it.
I love that. We'll follow a strict 7-part architectural blueprint today.
We will. We'll cover the core concept, the timeline, key terminology, important figures, vital statistics, cause and effect relationships, and finally, a comparative matrix.
I'm really excited to unpack the nuances of India's digital financial revolution.
So am I. And I promise you, no jargon, without a clear explanation and a pace that completely respects your time. So let's jump right into section 1 of our mental infographic, the core concept and title.
Okay, let's do it.
If we had to give this blueprint an overarching title, you suggested something earlier that I thought was just perfect.
Yeah, I'd call it the digital plumbing of India, how the RBI architected the world's third-largest fintech ecosystem.
Digital plumbing. I love that framing. Because plumbing is invisible until it breaks, right? But it's the absolute prerequisite for a functional city.
Exactly. You don't think about the pipes until the water stops running.
Right. Now, we need a 2-sentence summary of the chapter's main objective for the top of our mental infographic. What is the exact distillation of the text?
Okay, based exactly on the text, it's this. Fintech represents the convergence of finance and technology in India, driven by a powerful interplay of digital public infrastructure, institutional arrangements, and proactive policy initiatives by the RBI.
That's sentence 1.
And sentence 2, the Reserve Bank acts not just as a regulator, but as an institution builder and early adopter, fostering a secure, inclusive, and frictionless financial landscape.
Okay, let's unpack this. Because that phrase, not just as a regulator, but as an institution builder, that's the whole ballgame.
It really is the pivotal paradigm shift here, because historically, central banks are deeply conservative entities.
Right, they're the financial police.
Exactly. Their primary job is risk mitigation. They set the speed limits, they ensure banks hold enough capital reserves, they try to prevent systemic crashes.
But the RBI realized that in a country with India's vast geography and demographic scale, simply policing traditional banking wasn't going to achieve actual financial inclusion.
Yeah, no, not at all. They had to actually build the roads.
Right. So instead of just being the traffic cop, they became the city planner and the civil engineer. And honestly, the venture capital incubator all rolled into one.
That's a great analogy.
They're laying down the smart highways, writing the code for the traffic lights, and paving the autonomous vehicle lanes for the future of finance.
Precisely. Think about how seamlessly you use your phone to pay for a coffee or transfer rent today. That seamlessness isn't an accident. It is the direct result of this core concept.
Which brings us to section 2 of our blueprint, the timeline and chronology. Because to understand this present reality, we have to map the past. I initially assumed this all kicked off around, 2016 with the smartphone boom.
Most people assume that, yeah. But the source material points to an entirely different starting line. The early foundations actually span from 1996 to 2008.
Wait, 1996?
Yes, 1996.
Most of the world barely had dial-up internet back then. I mean, we were dealing with floppy disks. Why was the Central Bank of India doing this in 1996?
Well, the very first major milestone on our timeline is the establishment of the Institute for Development and Research in Banking Technology, the IDRBT.
Okay, so write down IDRBT on the timeline, folks. But why then?
This is what we mean by the visionary city planner approach. In 1996, the RBI anticipated that banking would inevitably transition from physical ledgers to networked digital environments.
So they were looking decades ahead.
Exactly. The IDRBT wasn't building consumer apps. They were tasked with researching the really unglamorous, heavy-duty back-end infrastructure required for secure communication between banks, cryptography, secure network topologies.
Laying the fiber optic cables before anyone even owned a computer.
That's it. And that foundational research paved the way for the early 2000s, where we see the initial surge in digital payments and mobile banking.
Which brings us to 2008 on the timeline.
Right. 2008 is a pivotal moment. The incorporation of the National Payments Corporation of India Ltd, or NPCI.
Highlight MPCI on your mental timeline. They are massive.
They are the absolute engine room for retail transactions. Before them, things were fragmented. NPCI centralized the clearing and settlement process for retail digital payments.
Okay, so that's the early foundation. We have the Research Institute in 96, the Centralized Payment Corporation in 2008. What is the next phase?
Next, we enter the boom of institutions and guidelines. This is roughly 2014 to 2018.
Okay, let's go year by year. What happens in 2014?
In 2014, an entity called IFTAS is set up, and the RBI introduces regulatory guidelines for payments banks. This was specifically to enhance financial inclusion.
Let's jump to 2016, because looking at the text, 2016 is just a massive year. It feels like an inflection point.
It is the inflection point. 3 massive things happen. First, RBIT is established.
Got it.
Second, the RBI introduces regulatory guidelines for account aggregators. This officially kickstarts open banking in India.
And the third thing?
The NPCI introduces the Unified Payments Interface, UPI.
Okay, put 5 stars next to UPI on the timeline. That is the crown jewel.
It completely changed everything. Then the momentum just feeds on itself. In 2017, regulatory guidelines for peer-to-peer or P2P lending are established.
Right. And 2018?
2018, guidelines for invoice discounting, known as TREDS, are issued, and the RBI formally sets up an internal fintech unit to handle all this growth.
Wow. Okay, so that's the institutional boom, which leads us to the modern era of innovation and global integration from 2019 to today.
Exactly. In 2019, they create the Regulatory Sandbox Framework. Then in 2021, the Reserve Bank Innovation Hub, the RBIH, is established, and they launch the first Harbinger Global Hackathon.
A central bank running a hackathon. I mean, again, that venture capital mindset.
It's totally unique. Then we hit 2022. On January 4th, the FinTech department is officially carved out as a distinct department within the RBI.
They doubled down organizationally.
Yes. Also in 2022, digital lending guidelines are introduced, and the pilot for the CBDC, the digital rupee, is launched.
And then 2023 is just a flurry of activity, right?
Yeah, it's relentless. Digital lending guidelines are refined. On February 21st, the historic UPI Pay Now linkage goes live, connecting India and Singapore.
Incredible.
They co-host the G20 Tech Sprint. In August, the Unified Lending Interface, the ULI, is announced and piloted, and the 5th cohort of the Regulatory Sandbox is announced.
Just a massive deployment year,
Right.
which brings us to 2024.
Right. In 2024, UPI successfully connects with Mauritius and Sri Lanka. And on May 30th, the Framework for Recognizing Self-Regulatory Organizations for the FinTech Sector, the SROFT, is released.
Okay, so that maps the past and present. Does the text give any future projections we need to know for the exam?
Yes, 2 major ones. For 2025, India's fintech market is projected to reach USD 150 billion. And for 2026, Project Nexus for instant cross-border retail payments is expected to go live.
Okay, if you're visualizing this infographic, you can see how the timeline just accelerates exponentially after 2016.
It really does. It goes vertical.
But as we went through that timeline, we threw out a massive alphabet soup of acronyms, UPI, TREDS, ULI, CBDC.
There are a lot of them, yeah.
Which brings us directly to Section 3 of our blueprint, key terminology and definitions. If you're going to ace a mental exam on this topic, you need precise, exam-ready definitions.
Absolutely. Precision is key here.
So let's unpack the jargon. I want exact phrasing from the text where it matters. Let's start at the very top. How is fintech officially defined?
The RBI uses the Financial Stability Board's exact definition, so write this down. Technologically enabled financial innovation that could result in new business models, applications, processes, or products with an associated material effect on financial markets and institutions and the provision of financial services.
Okay, Highly academic, but it basically means tech that materially changes how finance operates. Next term, payments banks.
Payments banks are defined as banks mandated to provide small savings accounts and remittance services to underserved areas. They are restricted from lending, but they are permitted to issue debit cards and offer internet banking.
Got it. So they take deposits, but they don't give out loans.
Yeah.
Next up, account aggregators, or AA. You said earlier this was the backbone of open banking.
Yes, bold this one. Account aggregators are NBFC intermediaries that collect and consolidate financial data from various sources, strictly with customer consent, and present it in a standardized format to authorized entities.
So they are pure data routing pipes. They don't lend money either.
Exactly, just data pipes.
Okay. Prepaid instruments, or PPIs.
These are instruments like mobile wallets and prepaid cards. The key exam point here is that they require strict KYC norms, and issuers must maintain escrow accounts to protect the funds.
Good detail. Next, peer-to-peer, or P2P lending platforms.
These are regulated as NBFCs, and they oversee alternative lending. The RBI imposes specific limits on transaction sizes and leverage ratios here to manage risk.
Makes sense. Now, here's a tricky one. TREDS. TREDS.
Right. TRED-S stands for Trade Receivable and Discounting System. It is defined as a payment system authorized under the PSS Act for uploading, accepting, discounting, trading, and settling invoices of MSMEs.
We will definitely break down the mechanics of that later because it's brilliant. Next term, regulatory sandbox and the related IRS.
The Regulatory Sandbox, or RS, is a framework where eligible entities can life-test innovative products in a controlled environment with potential regulatory relaxations.
A safe space to play and break things. And IRS.
That stands for Interoperable Regulatory Sandbox. It's for testing hybrid products that fall under multiple regulators.
Okay, next. Harbinger. Capital R, B, I in the middle.
That is the RBI's global hackathon to find innovative solutions to existing financial challenges.
Love that. Now, SRO, FT, self-regulatory organization for the fintech sector.
Defined as an entity designed to balance innovation with regulatory compliance and consumer protection.
Is an SRO just the industry grading its own homework?
Well, what's fascinating here is that it's actually about instilling ethical conduct and proactive governance before heavy-handed regulation is needed. We'll dive into the cause and effect of that soon.
Okay, two more massive terms. CBDC, the digital rupee.
It is the digital form of India's fiat currency. You must strictly differentiate between CBDCW, which is wholesale, for institutional interbank settlement, and CBDCR, which is retail, a risk-free digital medium of exchange for everyday consumers.
Wholesale versus retail. Keep that duality in mind. Finally, the ULI, Unified Lending Interface.
ULI is an enterprise-grade open architecture platform enabling seamless credit delivery by ensuring digital access to information from diverse data sources. It acts as a digital public infrastructure operating on a plug-and-play model.
Plug-and-play credit. That is a game changer. Oh, wait, I see two more minor terms in the text. Subtech and Project Nexus. Let's knock those out.
Sure. Subtech stands for supervisory technology. It means solutions utilizing data analytics, AI, and machine learning to analyze financial data, detect anomalies, and identify risks.
Basically, the RBI's AI monitoring system. And Project Nexus.
A multilateral initiative to enable instant cross-border retail payments by interlinking domestic fast payment systems.
Wow, okay, if you're listening, that is your definitive glossary. You have all the key terminology locked in.
And knowing those definitions is critical for the next section, which is the important figures and names. We need to know who the architects of this system actually are.
Exactly. Section 4 of our infographic blueprint. Let's list the prominent organizations and their specific contributions. Let's start with the FSB, the Financial Stability Board.
Their contribution is setting the global definitional standard for fintech, which the RBI adopted.
Simple enough. Next, the MPCI.
The National Payments Corporation of India. They are the engine of retail digital payments and, crucially, the creators of UPI.
Now let's group the next three together because it shows the RBI's layered approach to IT. IDRBT, IFTAS, and REBIT.
Right. This is a three-tier structure. IDRBT is the historical pioneer from 1996 doing the foundational academic research.
The university.
Exactly. Then IFTAS designs and deploys the current live IT services for the banks.
So FTAS is the engineering firm building the bridges.
Yes. And REBAT is dedicated specifically to cyber resilience. They test and protect the systems.
The Cybersecurity Defense Force.
Yeah.
University, engineering firm, defense force. That's a perfect mental model. What about the RBIH?
The Reserve Bank Innovation Hub. They are the catalyst for the Unified Lending Interface, the ULI, and act as the general evangelizer of innovation.
Got it. Now, what is NBBL? NPCI Bharat Bill Pay Ltd.
Their specific contribution is implementing an interoperable payment system for internet banking. This prevents settlement risks caused by having separate, fragmented payment aggregator integrations.
Okay, we'll talk about that fragmentation risk in the cause and effect section. Finally, the international players, the BIS Innovation Hub and MAS.
The BIS Innovation Hub conceptualized Project Nexus, and MAS, the Monetary Authority of Singapore, collaborated with the RBI for the historic UPI Pay Now linkage.
Fantastic. So we have the timeline, the definitions, and the key players. Which brings us to Section 5, vital statistics and empirical data.
This is where the scale of this project really hits you.
Here's where it gets really interesting. I want the raw data for the infographic, just the isolated, high-impact bullet points.
Okay, bullet point 1. Global standing. India is the third largest fintech ecosystem in the world based on the number of entities.
Third largest, bullet point 2.
Adoption rates. The adoption rate of fintech in India is an astounding 87%.
Wait, 87%? What is the global average?
The global average sits at just 67%.
I mean, let's just pause on that 87%. In a country with India's immense geographic scale, linguistic diversity, and massive rural population, hitting 87% adoption represents a fundamental rewiring of society.
It really does. It's a technological leapfrog. Millions of people bypassed physical checkbooks and magnetic stripe cards entirely. They went straight from cash to biometric mobile payments.
Which brings us to bullet point 3, market projections.
The market size was USD 50 billion in 2021, but it is projected to triple to USD 150 billion by 2025.
Tripling in 4 years. That's explosive. And the final stat.
It's about ULI metrics. Currently, 16 lenders are utilizing over 50 data services through the ULI platform, and these data sources facilitate exactly 12 distinct digital loan journeys, including Keystone Credit Card, MSME, housing, and dairy maintenance loans.
Okay, 16 lenders, 50 data services, 12 distinct loan journeys. Lock those numbers in your memory.
They're highly testable points.
Now, we've laid out all the pieces on the board. We know the what, the when, and the who. But to truly achieve mastery, we have to understand the why. We need to connect the dots.
Which is Section 6 of our blueprint, cause and effect relationships. This is the core logic of the chapter.
Exactly. I'm going to give you a driver, a historical friction point, and I want you to map out the consequence as outlined in the text. Let's start with the biggest one, driver. The creation of the India stack and the Jam Trinity, Yandan, Aadhaar, and mobile.
The effect of the Jam Trinity was that it provided a robust digital public infrastructure, which ultimately catalyzed the explosive growth of fintech in India. It was the bedrock.
Right. Without identity, bank accounts, and mobile access, none of this works. Okay, next driver. The introduction of UPI by NPCI in 2016.
Effect. It enabled seamless instant money transfers between bank accounts. This served as the ultimate turning point in India's fintech journey.
Now let's look at data. Driver. The need for safe, standardized financial data sharing without violating privacy.
Effect. That need led to the creation of account aggregators, or TAs. They intermediate consent management and kickstarted open banking in India.
Mechanically, how does that work? Because giving my bank password to a third party is a security nightmare.
Oh, absolutely. The AA solves this through a zero-knowledge architecture. The AA never sees, stores, or sells your data. They just act as a cryptographic pipe routing information from your tax portal to your loan officer, strictly based on your explicit revocable consent on your phone.
Brilliant. Okay, next driver. And this relates to the trading system we mentioned earlier. Driver. Severe liquidity challenges faced by MSMEs.
Let's say you're a small factory. You deliver goods to a massive corporation, but they won't pay you for 90 days. You have a cash flow crisis.
Right, I have to make payroll this week.
Effect. This friction prompted the RBI to issue regulatory guidelines for invoice discounting under TREDS.
So I upload my verified invoice to TREDS, and banks bid to buy it from me at a slight discount, giving me cash instantly.
Exactly. It mechanizes and democratizes invoice discounting at a national scale.
Okay, next driver. Separate, non-interoperable integrations between banks and payment aggregators. The spiderweb of thousands of one-to-one connections.
Effect. That spiderweb caused massive delays and settlement risks. If one node went down, the consumer's money was in limbo. This led the RBI to approve an interoperable payment system via NBBL. It acts as a central clearinghouse, standardizing the architecture.
Perfect. Next driver. The extreme friction and high cost of cross-border transactions. Sending money internationally is like sending a physical letter that gets stamped at every border.
Exactly. Effect. That friction drove the RBI to pursue bilateral linkages, like the UPI Pay Now integration with Singapore, and to join multilateral initiatives like Project Nexus to bypass legacy correspondent banking entirely.
And the final driver, regarding the ULI driver, the manual, paper-based, and highly complex integration required for traditional credit assessment.
Think about a farmer applying for a loan. The bank used to manually verify land records, tax data, crop output. It took weeks.
And the administrative cost was probably higher than the profit on the loan itself, so they just wouldn't offer it.
Exactly a fact. This resulted in the creation of ULI. It uses a plug-and-play API model to eliminate that one-to-one manual integration. It instantly pulls the data, reducing the cost and time of credit delivery for the consumer to literally minutes.
It turns verified data into a basic utility, like electricity. Plug into the wall, and the data flows.
It's incredibly powerful.
Okay, we are at the final section of our mental infographic. Section 7, the comparative matrix. The text presents two major dualities, and we need to contrast them clearly.
Let's build a mental markdown table for the listener. 2 columns. Matrix 1, CBDC wholesale versus CBDC retail.
Okay, row 1, target audience.
For wholesale, the audience is institutional participants of financial markets, the big commercial banks. For retail, it's everyday consumers and merchants.
Row 2, primary function.
Wholesale's primary function is interbank settlements and clearing. Retail's function is acting as a risk-free digital medium of exchange for everyday transactions, including person-to-person and person-to-merchant.
And row 3, features.
Wholesale focuses strictly on macroeconomic systemic efficiency, but retail pilots include programmable and offline functionalities.
Let's highlight programmable money. That means the government could issue an agricultural subsidy token that can only be spent on fertilizer at specific merchants, and it expires in 90 days.
Yes. You simply cannot do that with cash or a standard bank transfer. It fundamentally changes fiscal policy.
Mind-blowing. Okay, our second comparative matrix. ULI operating models. The text contrasts the current state versus the future state.
Right. Row 1, current state. It currently operates strictly within a business-to-business or B2B ecosystem.
So the consumer doesn't even see it?
Exactly. It connects lenders with data service providers via open APIs on the back end. The bank's loan officer uses it.
Okay, row 2, future state.
Once stabilized, the platform will transition to a business-to-customer or B2C model. It will directly interface with the end borrower.
So in the future, I log into an app, the ULI packages my data, and I broadcast it out so banks can bid to give me a loan in real time.
Exactly. It flips the entire power dynamic of lending. But the cyber resilience required to open that to millions of consumers is monumental, which is why it's B2B for now.
And with that, we have completely filled out our infographic blueprint. If you are listening to this, congratulations. You have successfully mapped out the ultimate, highly detailed mental model for Chapter 24.
You have the historical timelines, the exact definitions, the empirical data, and the causal links. You are ready for the exam.
But before we go, we always like to leave you with a final provocative thought, something to mull over that builds on this material.
Right. If we connect this to the bigger picture, the RBI is heavily utilizing subtech and AI. They are building massive digital public infrastructure like ULI and programmable CBDCs. So the question we have to ask is, what happens when fintech adoption in India actually hits 100%?
What happens when everyone is plugged into the digital plumbing?
Exactly. Will the concept of a traditional bank branch entirely cease to exist? If the ULI pulls your tax records and land holdings instantly, and a retail CBDC delivers the funds directly to your phone, physical geography becomes completely irrelevant to global finance.
The physical bank vault, the local loan officer, the paper ledger, they all become completely obsolete.
I'd invite you to ponder how, very soon, your own digital footprint, your verified data profile, might be the only collateral you will ever need to secure a loan.
It's the democratization of capital at a scale humanity has never seen.
They aren't just regulating money anymore, they're regulating the velocity of trust.
The velocity of trust. What a perfect place to end. Thank you for taking this deep dive into the architecture of India's financial future with us. Review this mental blueprint whenever you need to feel instantly well-informed on global fintech trends. Until next time.